The following is a presentation of TFNN. The Trader's Edge with Steve Rhodes. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. The Trader's Edge. Now, Steve Rhodes.
Good afternoon from TFNN. Welcome to the August 14th fantastic Friday edition of today's Trader's Edge Show. I'm your host, Stevie Perseverance Rhodes, who absolutely knows that each of us should always be pioneers of our future versus prisoners of our past. Hope everyone out there is having a fabulous day. Let's make sure we have an extraordinary weekend. Of course, the easiest way to do that is to always remember that life happens for us, not to us. That's right. When you and I make that one little 2x4 shift, it means we can find the gift in every set of circumstance that life is going to toss at us. Today, we'll go take a look at the circumstances that the bulls and the bears, the buyers and the sellers are throwing out to you and I. I'm absolutely grateful for your presence here. I'm honored by your presence, and I'm here to serve you. Feel free to pick up that phone, dial on it at 877-927-6648. Of course, internationally, you can call us at 727-445-1044. This is Fantastic and Fabulous Friday. Of course, it's Tiger Financial News Network. I'm Steve Rhodes. Welcome to the show. Right now, we got the Dow trading up 32 points. She's trading at 17,440. S&P's up 3 points at 2086. NASDAQ Composite down 5 points at 5,028. Russell 2000 flat, trading at 1204. Light sweet crude is what we're going to focus on here in the opening segment. It's up 27 cents, 42.50. Gold's back $3. Silver's off 18 pennies. Leading the charge, the upside, it's Kemp Harm Inc. That's up 27%. Transdigm Group, that's up about $4. Sherwin-Williams is painting the town green right now, up about $4 as well. So South Coast Financial up about $4. To the downside, Credit Corp down 960. Priceline off $5. Spark Therapeutics looks like it needs a new spark plug. It's off about $6, 11% out there. Aspen Technology down 12%, off $5. But first, what I want to do is start off by taking a look at light sweet crude. So let's go dissect and bisect, as our fearless leader likes to say. Now, I'm going to first pop up on my screen here the current contract for gold, the September contract for gold. Let me blow this up just a tad for you. And one of the things that you and I, let me just move it over here a little bit to left. Hopefully, you're watching us on TigerTV, but you can always catch the archive of the show on channel 9, I believe it still is the archive. And one of the things that we're taking a look at is an expansion of swing points. You know, the market's either contracting or expanding. In the case of light sweet crude, it's expanding to the downside. One of our price measurement tools, our rulers out there, are the Fibonacci expansions between where we see major changes in trend. And all you have to do is look at a stock chart, see where you see a significant change in trend, and those become your points of measurement to begin and end from. In this case here, that would take us to the March 18th low inside light sweet crude. That's at $49.69. That takes you all the way up into the high on the trading day of May 6th, out at 64.45. If you go from those 2 points and you just simply expand that price difference and then go ahead and subtract that from the beginning point of that March 18th low, well, there's really 2 Fibonacci expansions that we look at. The 1.272, the price of gold, I say the price of gold, the price of light sweet crude blew through that, so I don't even have that on my screen here for us to look at, just to unclutter it. And what we can take a look at is the 1.618 expansion. Now, that price objective is 40.57. We haven't hit it. We haven't hit it exactly. Remember, we use these like Jack Sparrow. We use these as guidelines. The price projection, again, 40.57. So far, what we have seen out here is 41.35. Now, there's no reason at this stage of the game for us to believe that price won't get down there. Now, it can get lower, but there's no reason for us to believe that price won't be able to get down there. Now, the reason that I say that is, as we speak right now, there's no bullish reversal signal or anything. Just because my candle's green, that's just the difference between where price opened and where price is trading at right now. So that's on the current contract. If we switch over and take a look at a long-term contract, And we're going to go we're going to take a look at the continuous contract out here, just to understand what's going on. That takes us back into, well, first of all, what light sweet crude is doing on the continuous contract is testing the swing point from back in March of 2015. It's monthly that we're looking at. So that low is 42.03. You've tested it, you've rejected it. That's one element out here. Now, if this area here fails, and we'll call it close below 42.03, it sets up the potential or the possibility that price will get all the way down to 33.20. But maybe not so fast. This is where we really have to continue to watch this to look for some type of signals out there. Now, the reason that I say that, this just helps us to give us our gauge as to where we're at. And our antennae need to be up, in my opinion. If you're looking for a trade, the trade, in my opinion, if we get the right signal, would be right here. Now, that's going to impact a number of different things. I mean, we can go take a look at the energy sector, the XLE. That should impact that. That impacts a number of big names out there that have been trashed, and it is worthwhile for us to investigate it. Now, there's one other chart. Let me pull this over here. That's a reason to investigate it, and that's this one right here. Now, I've pulled up the continuous contract. It looks the same, but let me go ahead and shrink a couple of these tools down to the downside. I don't really need them out there. We don't need to take up space. But it's really the same pattern that we're looking at on the current contract here. And that pattern is thus. That is, we can see at this stage of the game, price has been moving lower with less relative weakness. Hence, what we see here is we see that little diagonal black line on my chart. And when that shows up, your antennae really need to go up. Why? Because it's a pattern that is associated with bottoms, at least tradable bottoms. This is not to say that this is the ultimate bottom or anything along those lines. We're looking at this stage of the game for trades, just as it did when light sweet crude had bottomed out back here on January 29th, January 30th. What you can see is it was doing really the same thing. In fact, there were two morning star patterns that had formed out here at the bottom. It presented a reasonable trade. In fact, those lows basically held, and that went ahead and set light sweet crude really up into the high that took place out here on June the 10th. And from that June 10th high now down to the lows out here, we've got one of Stevie's, and it should be your favorite pattern, as well as our secondary favorite pattern, and that is that it's in that seventh inning stretch. That means if we take a look at our wave count to the downside here, we are in that seventh wave. So we know we're coming into a swing point area. We know we're coming into a swing point on a monthly basis. We know we have price that's stretching out to the downside. Now what you and I need to wait for, my opinion is, you want to wait for some type of bullish reversal. You see, the buyers and sellers, they cannot hide from you and I. That's the really cool thing, is there's really only one primary role that all buyers and the sellers provide to you and I, and that's the role of painting signs. And the signs that they paint, the way they communicate to you and I, is they produce Japanese candlesticks. Now, there's like 35 Japanese candlesticks out there. The reality is there's only 10 that you need to focus on. All of the other stuff is just noise. You know, imagine if you could cut out all the noise in your life out there, just how beneficial that would be. You know, all the pings, all the unnecessary emails, all the junk stuff and so forth. That's a great thing when that can happen. In any event, let's get back on track here. When we take a look at light sweet crude, it appears at this stage to be setting up for a buyable bottom. Are we there yet? No, I don't think so. And I wouldn't even suggest taking that trade, because price could move lower and all of a sudden that weakness picks up and that pattern that we just took a look at would go away. If it goes away, then the only thing that we have to take a look at are the swing point and the fact that you're in a seventh inning pattern to the downside out here. So, you know, it hasn't set up here just yet. Will it set up later today, come tomorrow? Not tomorrow, but on Monday, Sunday? It's always possible. So I think that's one thing that you want to go ahead and focus on and take a look at. Let's go take a look at some other elements. You've got the Dow's up 56, S&P's up 5 right now, Composites up 2 points. Really been relatively flat market out here with the exception of the Dow. Dow. So let's go check in on our summation index, our price oscillators. Let's just go see where they're trading into. And in the case of the Dow and the New York Stock Exchange, that would be the left-hand side of my screen. That's the New York Stock Exchange. And the dead right is the Dow. As we speak right now, as of 1:16 p.m., both price oscillators back up above zero. Now, the New York Stock Exchange finished below zero yesterday. It's the second time in a matter of, well, it's the second time since it looks like July 29th that we've seen at least a one-day dip below that. Now, if today the New York Stock Exchange, let me blow this up on my screen for you. If today the New York Stock Exchange price oscillator finishes back above zero, it's what's referred to as a simple structure. You see, in life, there's simple, and you always should keep it simple. And then there's complex out there. And of course, I try every day. I make an attempt to try to take something that is complex and make it simple. Everybody, Einstein's got a quote out there. Leonardo da Vinci's got a quote out there. Steve Jobs has got different quotes out there. And I don't know who is it that invented the KISS theory, which is keep it simple, Steve. You thought I was going to say something else, didn't you? It's the keep it simple, Steve theory in trying to explain what's going on. A simple structure says this. You see, when the price oscillator dips below zero, the initial interpretation is, hey, it's sellers who have control. But when there's no zigging and zagging, it just moves below zero and then moves back up on the other side above zero. It's referred to as a simple structure. What it says is that the buyers never lost control. Now, that's pretty impressive since we're going back to July 29th out here. And should that be the case today, it really just fits into the overall pattern, which we'll go ahead and take a look at. It fits into the pattern, the message that is really being communicated to us over the last 82 years, which is this: that the market wants to move higher into the end of August. Now, I've given you a date of August 25th. I'm not married and tied to that date out there. It is a date worth absolutely paying attention to, and I'll show you why, during the next segment out there. But if, in fact, the New York Stock Exchange finishes the day like this, and that's the wider swath of the market, its message is that buyers have been in control since July 29th, and that says price ought to at least get up to about the 10,924 level. Now, I say that because that's its 200-day exponential moving average, which is trading below. And no, that is not a good thing. That is not a good thing for you and I. But that's to be on the horizon. That has nothing to do with today. That has nothing to do with the death cross, which it will, I believe, if in fact price does not get above that 200-day exponential move, which I don't think that it will. The way things seem to be lining up here is that price is probably going to run right in to its descending price channel. That's that yellow diagonal line on my screen, right at about the same time as it gets up to about that 200-day exponential moving average. And then maybe it is back up the truck. Of course, if you're going to back up a truck, all that really means is make sure you take the right position size, because there's only one thing that you and I can control in this business, and that is risk. And that means proper position sizing. There is nothing more important than making sure you only take the proper position size out there. This is Steve Rhodes with TFNN. Right now, we've got the Dow. She's up 56. S&P's up 5. We come back from this break. I'm going to try to put it all together for you in the best keep it simple approach that I can come up with. We'll be right back, folks. Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
TigerTV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. TigerTV, exclusively at TFNN.com. Steve takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. Before the show started, Ben from Tallahassee called, asked if I would go ahead and take a look at the GLD. So, and what I've got up on my screen here is a continuous contract for gold. Now, we just spent a little time taking a look at light sweet crude, and as you can remember, there was nobody and their brother and sister and anyone else in that family, for the most part. I won't say there wasn't anyone, because there were some of us that were looking for a bottom in gold. Now, the same pattern, we take a look at the contract here, the continuous contract for gold, very similar to what you and I were just looking at inside of light sweet crude, and pretty much everybody's written it off. Nobody wants it. Now, I have to take a look and see where the commercial traders are positioned, how they're positioned. In gold, it was very clear. They were expecting a very viable bottom out here. And what you and I knew ahead of time was that the gold contract was down in that seventh wave pattern formation, made that seventh wave, letter G down there, also had a price relative strength divergent pattern, and then voila, went ahead and gave you the signal. That signal was right here. That was a piercing candle. That was a key reversal session. Key reversal meaning that we saw the prior day's high and low exceeded. We saw a close in the opposite direction, meaning a green candle in this case out here. And we had a bearish, bullish reversal side. Now, what was also cool about that is we had the bottom of our box in our daily market profile. That was a buyable bottom. What did Stevie do? We bought that bottom. Now, gold just simply moved sideways for a couple of days out there. And then finally, at the early part of this week, started to bust out of it. Now, the real breakout took place a couple of days ago, August the 12th. Now we can see that Goldilocks is pulling back and just testing the top of that box. Now, the top of that box should be support. It's like 1180, I believe, is the exact number out there. That should act as support. Doesn't have to, but it should act as support out there. If we take a look at the GLD, so I'm just showing you that these patterns, the cool thing about pattern recognition is that it repeats over and over again. At least what it does is it gives you a competitive edge. A competitive edge against maybe what other traders have out there. And as far as I know, a competitive edge is a good thing to have out there. If you use the proper position sizing, then life is good. If the trade doesn't work out, the trade doesn't work out, and you look for that next same pattern out there that works over and over and over again. Well, in the case of the GLD, we can see that it's trading right now back in the top of its daily market profile. So I don't know if Ben is long, short, looking to get in. It doesn't really matter because the advice would be the same. The top of that box is 106.72. You're trading out right now at 106.68 inside of the GLD. As far as I'm concerned, if you haven't gotten in on the trade, this would be a spot that you could get in on. You would have to have a wider stop out here than normal, than when you bought the bottom, but you'd have to have, and you can see, if we take a look at the patterns down here, what was it, June, or was it July? I don't remember the exact date. Let me look here. Let me look. That was on July 31st. And on July 31st, if I go to that, you see this candle here in the GLD, it wouldn't have given you a reversal signal or anything along those lines. That's why I've always suggested that, look, you don't have to, if you're trading basically these underlying instruments like the GLD, like the S&P, the SPY, something like that, you really want to have access to the futures contract, because that's where all of the consistent signals are coming from out there, and as we just showed you out here. So in the case of the GLD, if it fails at this area, at this price point, then 105.40 is likely the spot where you would see the next level of support. And if it fails there, 104.09. And if it fails there, then hey, guess what? The trade was short-lived, it was wrong, and que sera, sera. But at this stage of the game, we know that the GLD moved higher with volume. That was on the trading day of August 12th. Yes, that was 10 million shares. Yesterday pulled back with 4.7. And so far today, even lighter volume, 2.4 million shares. So you've got that nice pullback. Where's the GLD headed to? If in fact it holds support here, it's probably headed to 112.20, maybe higher out there, but 112.20, you can make the case to the 115, 116 area. But we've got to take all of this stuff one day at a time, one moment at a time. So thanks, Ben, for calling. Sorry that you weren't able to hold, but have a nice weekend out there. In the next 30 seconds, what do we want to take a look at? Let's go look at the XLE out here, see what it is doing, if we've got any kind of signals out here. Now, in the energy sector, the XLE, you did get a nice little bullish engulfing candle. I don't know what the wave count is to the downside there. Looks like we also have a price relative strength divergent pattern. Voila. That's a very nice pattern. And price here in the XLE trading right above its TAS market profile high out there. Something to think about. Yes, folks, black gold, Texas tea. That may be the next trade out there if you didn't get in on that yellow gold. Steve Rhodes with TFNN. We'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization optimization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pezzavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on TigerTV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. Dow's up 60, S&P's up 6, Composite's up 7 points right now. And in that spirit of keeping it simple, let me give you a little presentation, so to speak, that will help you understand where it is that I believe that we're headed to. We're going to really focus on the Dow here. And for most of you, if you haven't test drove my newsletter service, Mastering Probability, just come over to the homepage at TFNN.com or type in www.tfnn.com/Steve. You can test drive that for the next 30 days out there. So what I want to cover for you in relatively short order is the key annual turn dates in the Dow. These are dates that you absolutely want to make sure that you are aware of, where we're at now and what to anticipate in the road ahead. The likely measured move price projection. I'm going to show you how it is that I've determined where I believe that we're headed to overall inside of the Dow, and then the move after that correction. Now, the whole theory here, the whole idea is for me to use that keep it simple Steve-O process in communicating to you, because you know the terminology and things that we use out there, they really can sound like you know, stuff that is difficult to follow. So the easiest thing to do is to know that patterns occur all the time. You have patterns, I have patterns. Sometimes we call them rituals. You start your day off the same way most every morning. You drive to work or between point A and point B the same way over and over and over again. Well, guess what? And really, you don't change those patterns. None of us change those patterns until we see some kind of a sign out there. You know, if you're driving, maybe it's a stop sign, a yield sign. It's some type of detour sign out there. Otherwise, you just maintain those same patterns. And the stock markets work exactly the same way as you and I. After all, it's just a group of yous and I's that are inside the stock market. Now, over the last 82 years, that's what this study, many of you have seen this before, so this is nothing new out there. But what I want you to know is I've taken 82 years worth of data by day and averaged that so that I can determine, so that you can determine, so that you can understand the pattern inside of the Dow. Basically, the Dow has 4 or 5 real key turning points. The first one is that the Dow makes a bottom in January, the end of January, early February. That's what it did this year, like most other years. That's the point in time when you take a look at your retirement funds where you want to make sure that you're in and you're taking advantage of that. The second key turn date inside of the Dow is in the middle of May. This year, it happened to be May 20th. And then what happens is the market usually heads sideways to lower, and it makes a secondary high. Sometimes it's a slightly higher high, which takes place in July. Really, the sell in May, if you take a look at the course of the last 82 years, the actual sell in May cycle should really say sell in July. Now, in this case here, inside the Dow, it made a lower high, but it was a significant high, which was the July 18th, July 20th, sometime right around there. Maybe it was right on the button there, July 20th. Then, as far as what the market does, is it moves down into October. This is 82 years worth of data. This is the normal pattern of the market. Don't be paying attention to how far the markets have moved. Use these as cycle type dates out there, as pattern dates out here inside the market. The next high is not scheduled till August 25th. Today is what, the 14th? So we've got 11 days, 11 calendar days before that takes place. That's why I called that date. I know it's going to be in or it should be in or around that. Why? Because I know the pattern of the Dow. You know the pattern of the Dow. If we take a look at where we're at right now, we're at the week where the market was supposed to make a significant bottom. Did we do that a couple of days ago? At this stage of the game, the answer is yes. I mean, the market came crushing down. Who knows why? Do you think that over 82 years worth of data, really, that the market knew that there was going to be issues in China, this, that, or the other thing? No, it's just the normal pattern out there. What was the real pattern? Was it 82 years worth of data, or was all the other fuss that was in there? So at this stage of the game, the market is traveling along the way that it really should. Now, in fact, here's a monthly chart for the Dow. And all those arrows that I have in on my screen out here are basically October lows. Sometimes they came in late September, sometimes early November. But for the most part, and I mean like 95% of the time, it's really the October low. Now, if we had a daily chart, you would see a whole heck of a lot more price movement. The more important thing is, does it always work? No, sometimes the Dow into October moves higher and then even moves beyond that. There are times where the market has moved higher into October, and then it's been curtains out there, such as the highs back in June of 07. Now, there's a lot of people, I say a lot, there are a number of people calling for a crash, a 7-year cycle, this and a that, a fear-based thing out there. I don't know. I've gone back and I've looked at my charts, and I say people are using limited information. I'm providing to you unlimited information, 82 years worth of data. And I'm going to go with the 82 years worth of data versus people that are believing that a 7-year cycle just happened to start in 1987 out there. Let's go with 82 years worth of data. And here's what we know about this chart out here. In fact, what we really know is that everything is going along as it should. It's going along as it should. But here's the deal. There actually was a warning sign on that chart. And that warning sign may be saying run like hell. So to a certain extent, those folks that are calling for this significant top, the market to be in this huge bear market, to go all the way down beyond the lows of 2009, I'm okay with you on the warning sign of the market. What you and I may differ on is where the market is going to go. But let's go see where this market could go. And you have to determine whether or not that's really going to go ahead and cause any pain. Because you see, no matter what, I don't want you to be left behind out here. You see, the Dow is trading below its 200-day exponential moving average out here. And that is what I have on my screen out here is a version. It's a monthly chart. So you're not going to use a 200-day on a monthly chart. You can use something like 6.6, 6.7. But in this package here, it only allows me to use round numbers. So I'm just using a 7-month moving average out here. But it's a good enough line. And what the pattern that is out here, the last time coming off of the March 09 lows, that's all the way down here where my cursor is at. So coming off of that March 2009 low, it's really the second, third time that we've seen price close below or be below. The month is not over, but be below that 200-day, 7-month exponential moving average out here. Now, the time when we were entering into that sell in May-ish cycle, that unfavorable seasonal cycle, was back here in 2011. And in 2011, we see that prices, so this is the most similar pattern that we've seen off of the 2009 area out here. So that says to me, all that I've done is I've measured from the high in 2011 to that October low that came in. And all I've done is really applied it to the high that we've seen here, which was our May high, May 18th, May 20th, something like that, and just simply use the same price projection. Now, voila, when we do that, it comes down and it says that price is going to move down to the October lows out there. This is at least with regard to the Dow. Makes sense. Hey, we've got our fearless leader on the show here. He's saying the markets are headed back to that October area out here. Well, with regard to the Dow, I happen to be in agreement with him after we get to this August 25th. Now, that says that the price target is right around 15,855. That would, in essence, be from where we're trading at right now. That would be about a 9% correction from the high down to that low. If in fact it occurs like that, that's about a 13% correction. That would be the first greater than 10% correction, I believe, that we've had in quite some time. Maybe, I don't know, was it a 10% correction back there in 2011? Maybe somebody could let me know if that was. It doesn't matter whether it was or it wasn't, but it would be the next. Now, hey, let's not overlook the fact that price had been moving higher on less relative weakness out there. And if we took a look at a monthly chart, it's also in its 7th wave pattern on the Dow chart. So there is a reason to certainly be very nimble and very careful. What I believe you need to do, if you were tied to the Dow, and look, it's all the indices are going to retrace out there. So you want to take a look at your portfolio, see how things are allocated out here. But to the extent that you're in my age category and you're using some type of money manager out there, there's a pretty good chance that you've got a decent amount of your portfolio in what supposedly is the safe sectors and stocks out there. They're not going to necessarily be so safe if, in fact, my read on this is correct. And I am not one to sell fear. I'm one to teach you how to buy fear out there. But we need to always be aware of fear, because usually fear is false evidence appearing real. Now, here is the deal. So you've got to determine. So I think 15,855 is a real deal. But after that correction, that's when you're going to have, assuming that the pattern just remains the same. There's nothing different about the pattern that we're taking a look at. And that says that sometime in October, if the pattern plays out like this, that says that it makes its next bottom, as it has so many times before, and then the Dow heads up to 20,500. Yeah, 20,500 is nothing more than the consolidation pattern from back here in 1994, 1997, I guess 1997, to those highs in 2007. And really only if price gets back to the 2007 highs does this pattern become null and void out there. So that is I hope, my keep it simple approach as to what the Dow is doing out here and what it is that you can anticipate, coming into. So expect the markets to just kind of budge and gradually move higher into the end of August. Maybe it's not August 25th. Maybe it's September 4th or 5th, or we come back from Labor Day. I don't know. But it's we're getting very close to it. And you should prepare for that. That doesn't mean you exit the stock market. It would mean, hey, go ahead and make sure that you please have stops in place out there. So the key annual turn dates in the Dow. You understand now where it is that we're at, what it is that you can anticipate, what the measured move would be. That would be our first target, our measured move to the downside should the market move down into October. And then you also know what the move is after that, and things look pretty good. So back to the charts out here. And if you got questions, feel free, send me an email. Anything that I can do to assist you. The Dow's up 54, S&P is up 5, Composite's up 4. As far as the day is concerned, if we switch over and let's go from monthly charts to intraday charts out here. What we're going to see is that the ES-mini, the S&P futures contract, its struggling area is at 2088 and a quarter, right in that level. That's where we've seen the largest number of opens and closes, 52 to be exact, over the last 1,600 bars, whatever that represents in days out here. Plus, I've gone ahead and gotten rid of some of the noise, some of the lack of noise out there when the market just does not a whole lot between the time period of about 6 at night until about 4 o'clock in the morning out there. So 2088. Same thing that we talked about yesterday is really a key level of resistance. If you see price overtake that at any point in time, then, and I don't mean just spike it, I mean close above it, then what that's communicating to you and I is that the next stage, next level to the upside inside the ES Mini is going to be 2101. So you're at 2083. That's about another 17, 18 points above where we're at. And you can tack that on to what the S&P is trading at right now to give yourself some kind of price projection as to where price might head. Is that the end of the move out there? No, I think we have to take a look at time as much as we do price inside the market. So if we go take a look at the ETF structure for you, if we look at the QQQ to start off that view, the Qs are trading sideways to really just sideways out here. 11 million shares. Yesterday made a slightly higher high with 22 million shares, so we're seeing a retracement with lighter volume out here. Qs ought to try to make a run for the 112.06 area out there as its next target. We look at the Russell 2000. Oh, mentioning the Russell 2000 now. If you're one that says, hey, Steve, I dig that forecast and everything that you came up with, and, you did really keep it nice and simple for me so I can actually explain to others what it is that the market is doing at this time. The actual place to be on the short side perhaps is not the Dow. The place to be on the short side is perhaps Russell 2000. Let me share with you this chart here. You see, the Russell 2000, the market responds better when the Russell 2000 is the cheerleader out there. And the way that I take a look at it being a cheerleader is I compare the small caps to the big caps. But I do it by taking a look at the correlation between the Russell 2000 and the Russell 1,000. Now, the blue line on my screen happens to be that ratio. The red and yellow lines on my screen, I'm referring to the bottom panel out there. That just happens to be two moving averages, 19 and 39. And when you see a crossover there, it's never a good thing. Last time of any significance, the crossover, that occurred back here in 2014, sometime around the March 2014 area. And you also had that ratio where it was the small caps that were now out in front to the downside. Never a good sign when that takes place. We can see that is very clear right now. That says that the Russell 2000, in my opinion, is weaker than is the weakest of them all. But you knew that before I communicated that to you. But what I want you to understand is it's coming from a weak spot that is just not good. It just does not end good out there. So that's really the place where you'd be looking at from the short side of the trade out here. If we take a look at this here, takes a look at the Russell 1000 versus the 2000, only in a different way, in a diverging way. And that shows us that here, just an example where we're at right now, we can see that the Russell 2000 made a lower high back in the middle of July, whereas the Russell 1000 basically made the same high on July 20th as it did on June 23rd out there. There was a diverging pattern, and typically it is the Russell 2000 that points the way for us. You can see that we had some divergence back here. This is back in the September time frame. The market actually last year made a high right around September 3rd inside the Russell. I think it was September 18th maybe, or so inside of the Dow, if I'm not mistaken. And then it went lower into that October time frame. Well, the Russell 2000 there, that divergence led to a market moving down. Same thing back here in the July time frame. Now, look, it has not always worked. There was a time period here where we saw a divergence. And that was back in May of 2014. And that really wasn't an indicator that worked all that well. But it mostly does. Steve Rhodes with TFNN. We'll be right back, folks.
Are China A shares hot or not? If you trade China A shares, now may be time to take a closer look. Trade CHAU or CHAD Directions Daily CSI 300 China A-Share Bull and Bear ETFs. China A-Shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
If you're looking for a great opportunity to diversify your financial portfolio, consider the Principal Protected Market Safe CD from Everbank. They've just released the second running of their 5-year Market Safe Power Metal CD, which combines the power of gold, silver, and copper. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your deposited principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Intrigued yet? The August 17th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN. Everbank is a member FDIC.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Welcome back, folks. Dow's up 42, S&P's up 4. Perhaps the trading gods will go ahead and give us what we want or what they do on average, and prices will move up for the next 11 calendar days or so. In the case of the IWM, which you and I would be looking for, we'd be asking for those gods is for price to move up into that descending price channel line out here if you wanted to take a stab at shorting the Russell 2000. Now, that price would take you into about the price range of around 122.60, not to be exact or anything, 122.52 to 122.60, but let's not hold me exactly to that figure. But that would be the spot that would be ideal to go ahead and take a stab from. If price moves out beyond that, then we'll have to reassess and take a look at what might be going on. The IWM today testing a swing point here. That's the July 28th swing point that had 53 million shares on Muy Grande light volume. Boy, that was really poor combined language out there. We'll just simply call it very light volume to the downside. It's trading into the low of August the 12th, which had 46 million shares. So you got the right kind of setup here for a light volume move that continues to the upside. If we look at the SPYs, the SPY trading at 209.01, it has tested and rejected its swing point from the trading day of July 7th a couple of times, 173 million shares there. It was tested with 116 and failed. It was tested with 126 and failed. It was tested with 172 and failed. That was similar volume. It was tested yesterday with 89 and failed. Now, it doesn't have a whole lot of room to run to the upside out here. It's got this little trend line that it's not been able to break above. That's going to be key for us to watch. And that says price ought to get up and at least tag the 210.50 area. If it can get above that, then the S&P could actually run up towards its highs out there. But even if that were to occur, the market was able to somehow bust out and run up to its highs as we come into August 25th out here, let's not for any reason believe that the pattern out here is any different than what it is that we have been looking for. If we go take a look at the Dow Diamonds, and if it does change, I'll be on my horn, ride my horse, telling you that, hey, something has changed here. If we look at the Dow Diamonds right now trading sideways to slightly higher, 1.8 billion shares out here. Trying to, well, what the Dow Diamonds in essence have done is has a new swing point from August 12th with 8 million shares. It's tested the top of that. It's rejected it. And it has some resistance. I would say most likely the resistance here between 176.06, 176.67, right around that area out there. So that covers the ETF structures. Nothing else. Probably another area to be focused on, I would say, in preparation for the decline we ought to see that goes into the time period of October is the XLK, the technology sector. Probably not a bad place to be looking around, and I say that because of that island reversal out here. So you got that island reversal, that Gilligan's Island. They've stranded all those passengers, Mary Ann, the skipper too. I gotta forget how that song goes, but something along those lines out there. And as long as that pattern's in play, it's a very bearish pattern out here. Maybe the XLK will go ahead and bounce up to 42.90, maybe 43.03 out there. Now, if it gets up and it gets to a price point of 43.09, then I would say don't necessarily look at the XLK because it will have saved all of those stranded passengers out there, and the pattern will not really be as bearish as it looks right now. So, folks, have a fabulous weekend. Stay tuned. David White is up next. After that, we've got the Tom O'Brien Show from 3 to 5 p.m., and I'll look forward to seeing you come Monday. Take care. Bye-bye now.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.